Sales variance is of two types, sales value variance and sales margin variance. Margin variance basically talks about the margin element, the profit element. So, let us make the diagram to show how sales value variance is represented, and then we will show in the same diagram how margin variance can be done. So, let us do the question, and for doing the question let us understand what is the format we need to do and what are the components of sales variance. This is a value variance. This is also called turnover variance. So, these are the different name you must know. This is actual production into actual quantity minus budgeted production into budgeted quantity. It has two aspects. One is sales price variance, another is sales volume variance. This price variance is actual price into actual quantity minus budgeted price into actual quantity. Right, friend? You can keep it in bracket also and create formula like this. Right? So, the formula can be either an extended formula or a reduced format of formula. Sales volume variance is budgeted price into actual quantity minus budgeted price into budgeted quantity. So, this formula can be shown with budgeted price into actual quantity minus budgeted quantity. The sales volume variance is bifurcated into sales mix variance and sales quantity variance. So, what is sales mix variance, friend? It is budgeted price into actual quantity minus budgeted price into revised quantity. One aspect. Another aspect is the quantity variance. Quantity variance is budgeted price into revised quantity minus budgeted price into budgeted quantity. So, this is the sales variance. One thing you must note about adverse and favorable variance is this, that the concept was earlier in terms of cost variance, that if we are crossing the standard cost, it is an adverse variance. Here the concept is just reverse. If you are selling more than the budgeted quantity, this means you are doing good. Therefore, crossing the budgeted quantity gives a favorable variance. So, this basic concept must be very much clear to you, friend. When we will be doing the numerical question, we will be using this concept often to decide whether a situation is favorable or adverse. After having obtained this particular thing, sales quantity variance can be further broken down into market size variance and market share variance. So, what is market size variance? This is budgeted quantity, or the better word will be budgeted market share in terms of percentage multiplied by actual industry sales quantity in units minus budgeted industry sales quantity in units multiplied by average budgeted price per unit. This is market size variance. In case of market share variance, I write it here. It is actual market share percent multiplied by budgeted market share percentage, right, into actual industry sales quantity in units into average budgeted price per unit. So, this is the formula which has come up. Let me explain you the different element very clearly. This variance relates to value or turnover, right? So, we are comparing actual sales here with respect to budgeted sales. Right? This is broken down into two parts: sales price variance and sales volume variance. Price variance is actual price into actual quantity minus budgeted price into actual quantity. So, what you do? You take out actual quantity and you put in bracket actual price minus budgeted price. In case of volume variance, you multiply budgeted price with actual quantity minus budgeted price with budgeted quantity. So, in short form, budgeted price is taken out of bracket and the formula becomes budgeted price in the bracket actual quantity minus budgeted quantity. This volume variance is again broken down into two parts: mix and quantity variance. Mix variance is budgeted price into actual quantity minus budgeted price into revised quantity. This revised quantity appears when sales ratio changes. In case of quantity variance, it is budgeted price into revised quantity minus budgeted price into budgeted quantity. So if you add these two, you will get volume variance, right? Likewise, this sales quantity variance is composed of two things. First is market size variance and market share variance. Market size variance says what percent of market from budgeted perspective is there with respect to actual industry sales quantity in units. From that, if you take away budgeted industry sales quantity into average budgeted price per unit, you have market size variance. The market share variance is actual market share percentage minus budgeted market share percentage when this element which comes out of these two is multiplied with actual industry sales quantity in unit into average budgeted price per unit, you get market share variance. So if you add these two, you get sales quantity variance. So this is the scenario when you have volume variance. Now suppose we have margin variance. How we create the margin variance? So very simple, friend, all words will be changed. Instead of value, you will write margin. So the formula remains same. What changes is this P, AP becomes AM, actual margin, right? So wherever you have P, all P becomes M. It shows margin. So the first formula in that case becomes actual margin into actual quantity minus budgeted margin into budgeted quantity. So what is margin? Margin is the profit. So wherever you have P, whether it is AP or BP, replace it with AM and BM, actual margin and budgeted margin. So that is the change we have to bring in the formula whenever, wherever the changes are. So if I have to do that changes, I am going to do changes now. You move with me. So this P becomes M. I am writing the margin formula. This is also called profit turnover. So I am now writing margin formula or profit formula. So this becomes AM minus AM into AQ and here BM into BQ. So this becomes actual margin minus budgeted margin. In case of this becomes sales margin variance or it is a profit variance. In case of sales margin price variance, in this case I told you P becomes M. So the formula now becomes, rest of the thing remains the same. In case of sales margin volume variance, this is BM, 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 right? In case of sales volume variance, which is now sales margin volume variance, in case of sales mix margin variance, here what you do, this P becomes M, right? In case of sales quantity mix variance, the formula becomes So, these changes you have to bring to get margin variance. So, formula is same, only P becomes M. So, replace P with M, which is price, M is margin. If you do this, you get the formula for profit variance. Now friend, where are the changes still needed? You can do changes here, right? Here this is right. Rest of the thing are same. Now I am going to do one problem and let us do this problem together. So I am going to rub this board and we will be solving the problem together to find the sales variance using both approach. One approach is value approach, another is margin approach. So the question is, the sales manager of a company doing business is interested to sell 3 products KLM, the units sold, the selling price per unit, the standard contribution margin per unit is provided, actual sales and corresponding sales value is given. You are required to compute the sales variance. So what is the first step friend? We make the working note for basic data. So let us make working note and the basic data. So first base is based on sales value or sales margin. So let's start working on margin first. So statement of computation of relevant details. So quantity, what are the product? Products are K, L and M. So let's write product here. You have budgeted quantity 2000, 2000 and 2000. 6000 is the quantity. Budgeted margin per unit, this is 6, 4 and 1. So budgeted, this was per unit. So budgeted margin becomes 2000 into 2, 12,000, 2000 into 4, 8000, 2000 into 1, 2000. Right? Actual quantity, this is 1500, 2500 and 3500. So 7000 is the quantity. We are also provided with actual margin per unit at 4, 3 and 2. So actual margin becomes how much? You have to calculate 6 into 1500. So this becomes 9000. Likewise, when you do the calculation, 4 into 2500, it becomes 10,000. So what we are getting here is standard margin. So 9,000, 10,000 and 3,500. So if you add, this becomes 22,500. The actual margin is actual margin per unit into actual quantity 6000. This becomes 2500 into 3 7500. This becomes 3500 into 2 7000. So, this becomes 20,500, right. So, we proceed our calculation further, we compute the variance. So, first variance is sales margin variance. This is actual margin minus budgeted margin. So, if you see this chart, where is the actual margin? Actual margin, if you see, we have for each of the product. You have to take up for each of the product, that is for K, for L, for M. So, let us start working on that particular one. So, for K, you start with the first one. So, this is how much? You see actual margin is 6000 and budgeted margin is 12,000. So, it is 6000 minus 12,000, therefore, you have 6000. Tell me whether it is favorable or adverse. It is adverse because the budgeted was 12 and you have done 6. So, you are below the line, right. For L, it is 7500 minus 8000, that is 500 adverse. For M, it has been provided at 7000 minus 2000. So, it is 5000 favorable. So, if you solve it, what you notice? You have two adverse at 6000 and 500. So, 6500 adverse, 5000 favorable. So, the result is 1500 adverse. So, this is the first variance, the margin variance. Now, you come to sales margin price variance. This is can be computed as a formula: actual quantity into actual margin minus actual quantity into budgeted margin. So, for K, for L, for M, we start working like this. For K, the actual quantity into actual amount minus actual quantity into budgeted margin can be redone into actual quantity into actual margin minus budgeted margin, right. So, let us do it like 6000 minus 9000. So, this becomes 3000 adverse. Why it is 3000 adverse? Because you have not sold anything more than budgeted. You have sold 3000 less than 9000. Therefore, it is 3000 adverse. So, you have got sales margin price variance for product K. Now, let us work for L. It is 7500 minus 10,000, that is 2500 adverse. For M, it is 7000 minus 3500, that is 3500 favorable. So, if you add all the three, what you notice? 5500 adverse and 3500 favorable. So, this becomes 2000 adverse. So, you have got sales margin variance. Likewise, we have to compute the third variance, which is sales margin volume variance. This is in terms of formula budgeted margin multiplied by actual quantity minus budgeted quantity. For KLM, we do it again for K, for L, for M. For product K, if you see this statement of computation of relevant details, you can look K and put the figure from that chart. It is 9,000 minus 12,000, which is 3,000 adverse. For L, it is 10,000 minus 8,000, which is 2,000 favorable. For M, 3,500 minus 2,000. So, it becomes 1,500 favorable. So, if you solve the equation, you notice 3,500 is favorable and 3,000 is adverse. So, on solving it, you notice 500 is favorable. So, friend, we have done sales margin variance, sales margin price variance and sales margin volume variance. Now, we proceed for bifurcation of volume variance in terms of the quantity variance and the mix variance. Therefore, I am going to rub this board and do the balance calculation under margin variance. So, we do the balance to subvariance of volume variance. So, sales margin mix variance. This is in formula shape. We can write it average budgeted margin per unit of actual mix minus average budgeted margin per unit of budgeted mix. This multiplied with actual quantity in units. So, this is the formula. So, let us do it. Find the average. So, in the chart, if you divide this thing with corresponding units, you get the average. If you divide 22,000 by 6,000 units, the average comes, and this figure has to be multiplied with 7,500 units. So, on solving this chart, you get the figure at 5,000 adverse. So, this is the sales margin mix variance. Now, we proceed to find another variance, which is sales margin quantity variance. Again, this is actual quantity minus budgeted quantity with respect to average budgeted margin per unit of budgeted mix, right. So, how we do, what is the actual quantity? 7500 minus 6000, the average is rupees 22,000 divided by 6000 units. So, when you solve it, this becomes rupees 5500 favorable. So, friend, you have got the two variances. If you add these two variances, you get 500 favorable, and this is the value of the volume variance. So, we have got the results as per the margin method. Now, we are going to solve it by another method. This method relates to value method. So, let us do the value method with me. For it, we are going to prepare that big chart where we are going to show all the relevant calculations. From there, we will proceed and solve using same formula, but instead of margin, we will be having production. So, that will be helping us to resolve the final solution. So, let us do it together, friend. So, statement showing relevant details. You have budgeted quantity, products K, L and M. The quantity is 2000, 2000, 2000. So, the total is 6000 here. You have budgeted price. So, what is the change in previous formula? Instead of margin, we have put price. This is 12, 8 and 5. Budgeted sales 24,000, 16,000 and 10,000. So, if you add it, this becomes 50,000. You have actual quantity. The actual quantity detail is 1500, 2500, 3500. So, the total is 7500. You have actual price at 10, 7, 6. Therefore, the actual sales is calculated at 15,000 given in the question, 17,500 and 21,000. So, if you add this thing, this becomes 53,500. The final thing is the standard sale. So, this is 18,000. 20,000, 17,500. So, if you solve, this becomes 55,500. So, this is the basic data which we are going to use in the other method, where we are going to compute under value method, the sales value method, how the sales variances are calculated. Now, we are going to compute under value method the different variances. So, sales value variances, this is actual sale minus budgeted sale. So, for product K, for product L, for product M. This is how we find it, 15,000 minus 24,000. If you see the chart, this is 9,000 adverse. Why? Because 15,000 you have incurred, 15,000 you have sold, you were required to sell 24,000, therefore you have not sold up to the mark, therefore adverse, 9,000 adverse. Likewise here 17,500 minus 16,000, which is 1,500 favorable. Finally, this is 21,000 minus 10,000, which is 11,000 favorable. So, if you solve it, the total will come at 3,500 favorable. So, this is first variance. Next we have sales price variance. This is again actual quantity into actual price minus budgeted price. So, for product K, for product L, for product M. Let us write corresponding units: 1,500 units, 2,500 units, 3,500 units. It is given at rupees 10 minus 12, 7 minus 8, 6 minus 5. So, if you solve, can you tell me the actual price is 10 rupees and budgeted is 12. Is it adverse or favorable? The answer is it is adverse. And how much adverse? 3,000 adverse. Likewise here you find this is 2,500 adverse and this one is 3,500 favorable. Why favorable? Because the budgeted price was 5 and you have sold it for rupees 6. So, for every 1 rupees favorable, for corresponding 3,500 units, the value becomes 3,500 favorable. So, if you put them together, sales price variance, this becomes 2,000 adverse. Now, we proceed to next variance, sales volume variance. For product K, for product L, for product M. For volume variance, how you start? You start making calculation, but before you need to have the formula: budgeted price into actual quantity minus budgeted quantity. So, rupees 12, 8, 5, these are the budgeted price. You write the corresponding quantity value, 1,500 units minus 2,000 unit. Here 2,500 units minus 2,000 units, 3,500 units minus 2,000 units. So, if you solve this thing, this becomes 6,000 adverse. Here 2,500 minus 2,500 into 8, this becomes 4,000 favorable. This is 1,500 into 5, 7,500 favorable. So, if you solve the 3 and find out what is the final value is 5,500 favorable. So you have got your volume variance. Now I proceed to get mix variance. This is again you have to take average budgeted price per unit of actual mix, per unit of actual mix minus average budgeted price of actual mix. This is multiplied with respect to actual quantity. Therefore, for K, for L, for M, we are going to calculate the value. So, what is the average mix variance? Friend, if you do like this, you are making one mistake. The mix variance will be one variance. It won't be for K, it won't be for L, it won't be for M. This mistake students are making in the exam. Therefore, you have to calculate it. Why one variance? Because you are taking average figure. You are not using each figure individually. So, please be cautious on this point. Therefore, the value is 55,500 average budgeted price. You divide it with 7,500 units minus 50,000 divided by 6,000 units. You multiply it with 7,500 units. The result which comes is 7,000 adverse. Now, the last thing you have to solve is sales quantity variance. In this particular case, again you are taking the formula. The formula is average budgeted price per unit of budgeted mix into actual quantity minus budgeted quantity. So, if you use this value 50,000 with respect to 6,000 units and consider the difference of 7,500 units and 6,000 units, what you get is 12,500 favorable. So, friend, you have solved the question. This will be one complete question. If it comes in exam, it has two parts. Either of the part can come in the exam. So, I hope the conceptual understanding has happened.